Hey, welcome back, guys. And in this lesson, we are going to be going over our risk-taking pattern entries and our breakout pattern entries. So the difference between these two is that in one, you enter the market before the pattern has broken out. So essentially before the pattern is done completing. And in the second one, you simply wait for the breakout to happen. So let me show you what I mean by that. We'll go to this move that just happened recently. So this all comes down to, of course, your knowledge of the market, impulse correction, continuation, everything like that. Also, with your pattern continuation entry methods, we use the EMAs with that 23 SMMA and the 80 close, and you can put whatever other EMA you want on there. I use the 30 close, but it doesn't really matter. You just need the 80 and the 23, and we reviewed that in the indicator video if you need reference on that. And you need your MACD. And I showed this a little bit in the indicator video, but I wanted to specify the two different types of entries that you could do with this. So the first one is our risk-taking entry. So what we'll do, and this works in a scenario when we have a clear impulse, and we've got a correction that's clearly happening right here. So your risk-taking entry in this circumstance would be when you're expecting this pattern to break up to the top, since it's a bullish trend. It's a bullish trend continuation pattern. So since we're expecting this to break to the top, your risk-taking entry occurs when you have a zero cross on the MACD and you've retested this SMA right here. So stop loss somewhere down here. And then you could have a take profit at the top of the target, or at the top of the pattern, or an extended target just to wherever you think that price is going to go. You know, you could set it to the top of this zone right here, using market structure to, you know, predict where price is going to go. So that is your risk-taking entry. The benefits of a risk-taking entry is that you can get a really good risk to reward ratio here. So you're able to get roughly a 3-to-1 risk to reward ratio by doing it this way. The drawback of this is that you're entering before the pattern actually breaks out. And one thing that can always happen when you're trading patterns is that patterns can change. And this happens a lot. So when this correction first started to form, we'll go back here. When this correction first started to form, it was making a flag. So it made a flag and it broke out slightly, but then it came back down and the correction just simply got bigger. So the pattern changed. It changed from a flag, you know, had this corrected down to here, we might have gotten this buy a little quicker. But since it took a little bit longer, we just had to wait. And waiting on the SMA is going to help you wait for the pattern to change and just wait for the pattern to complete all the way. So in this case, you wouldn't have been hurt too bad if you would have taken this trade on the breakout of the flag here, because it did end up going in your direction eventually. But what can happen is that price will start out as a flag, and then, let me erase some of this here, show you a hypothetical situation. So this flag can easily turn into a situation where you've got this, you've got a hypothetical breakout, but then price comes back down before continuing back up. And if that happens, then your pattern has simply changed. It changed from a flag to an expanding triangle. Okay? Now, if this were the case and we were waiting for this to correct, how do you think we could predict what the correction is going to be? Is it going to be a flat correction? Is it going to be an expanding triangle? Is it going to be just a normal flag? How do you know? Well, one thing we have is our SMMA. So if this is going to turn into the move that we think it's going to, if it's going to turn into the buy that we want, we can expect it to correct down to the SMMA. And in the previous lesson, or one of the previous lessons, we learned that we can use our Fibonacci retracement to predict where this is going to go to. And as you can see, it lines up really well just past the 0.382. And since we know that flat corrections typically correct down to the 382, it's much more likely that we correct to the SMA and we get a flat correction here instead of the expanding triangle. Simply because if you think about it, if we were to break down through this SMA, odds are more likely that price would correct and then continue down instead of giving us an expanding triangle. So with our knowledge of the market, impulse correction, continuation, we've identified the impulse. We've identified where the SMMA is, where we expect it to pull back to. We've identified where that is on the fib, and we know what pattern is going to coincide, or typically coincides, with that sort of correction. So now we have an idea of what to look for. So we'll play price forward a little bit. Get rid of that. Okay, so we're approaching the top. And we're coming down off of the top there. Okay, so we're getting the retest of the SMMA here. We didn't quite make it all the way down to the 382, but we got darn close. So we'll just move that up. And this is on the 4-hour, but it's funny because you can see a small impulse and correction right there, which if you brought that out to the 1 hour or the 15-minute, that would be a really big impulse and correction. But we'll see if price is going to go back to the top here. Okay. Starting to go up to the top. Coming back down. Okay, so at this point, we can be really confident that we've got a flat correction here. So at 2 points in this, we could have taken our risk-taking entry. We could have taken it here when we got the zero cross and the test of the SMMA, or here when we got the zero cross down here on the MACD and a retest of the SMMA. That is your risk-taking entry. The other option for trading patterns is to wait for the pattern to break out. And the reason why this is beneficial is because you have more confirmation on the trade this way. Because like I've mentioned before, price, there's no one who says that price can't just for any reason at all just come down here and correct and then go back down. I mean, that's always a possibility. It's less likely in this situation, but it's a possibility. And if you do it a risk-taking entry, you might not have time to get out of this trade if price starts to really move quickly and break down instead of continue up like it's supposed to and like how we think it's going to. So waiting for a breakout entry is going to give you the opportunity to probably have a better strike rate, meaning have more winning trades, but it's going to lessen your ability to have, larger return gains. So on the risk-taking entry, we had about a 3% trade. And we wait for the breakout entry. And I would not call that a breakout because if I drew that line actually across straight, it would not be a breakout. So right here, this would be your breakout entry. You've had 2 candles close above it. And we can be fairly certain that it's going to continue to go up. So how you trade this on any breakout is you enter, upon letting the candle close. And that's key too. You have to let the candle close because you can get faked out on these. And I'll show you that in just a minute, like a breakout versus a fake out. Okay, so we've broken out, the candle's closed, your stop loss goes down here. Let's use the same target as last time, which is about, right here. So for this breakout entry, it's not great because to be below the pattern, you only get a 0.71% risk to reward ratio. So you have a better chance to be right, but you're risking more than what you could gain on this trade. So that's just, in general, that's not a long-lasting way to trade. What you could do is move this to just below the moving average, try to give yourself a tighter stop loss and get that 1-to-1 risk to reward ratio. But then you're kind of sacrificing the safety of this move because it could easily come back down into this area and go back up. So you don't want to compromise the safeness of this move by having too tight of a stop loss. But that is the inherent risk in trying to have a safer entry point. And then as we play this out, we can see that it was a successful breakout entry. Boom, there you have it. There you go. Let's say we really got it to the top of the zone there. It's still only a 1.21 scenario. So what we have here, we have a risk-taking entry where we got 3%. And then we had a breakout entry where we got 1.21%. So in order for this to be the best move, this has to be right more often than this has to be right. So if this is a 3-to-1 and this is a 1-to-1, you can be wrong more often with this. So if you lose 1%, but you gain 3%, that means you could lose, if you lost one trade, you'd still be up 2%. However, in a 1-to-1, if you took 2 trades and you lost one trade, you would break even. So those are just things to consider when you're wondering if I should take a breakout entry or a risk-taking entry. And again, your risk-taking entry, the pattern can always change and you can get stopped out on that. But the breakout entry won't have as good of a risk to reward. So it all depends on your personality and your trading style. Like we've mentioned, several times in the course, it's not one size fits all. Like personally, I love risk-taking entries. When I see that and I see that, It just makes sense to me. Like, to my eyes, to my knowledge of the market, that works better for me. I'm not a huge fan of breakout entries, but I know people who will only trade breakout entries. And there's nothing wrong with that. It just depends on what you are most comfortable with. So let's get into like a breakout versus a fake out. And I'll try to find an example here real quick. Okay. We can use this here. This works for me. Okay, so let's pretend that this is the date and time. And we've got our zone marked up right here. And we're approaching this zone. So let's take things back a little bit here. Okay. So we've come to this zone. Let me hop down a couple time frames here. All right. So you've got this zone marked up. You've got price in an uptrend. Okay. We've got all these things happening here. So let's pretend that you're a support and resistance trader / breakout trader, whatever you want to call it. So on the 15-minute chart, this gave you a really big candle right here. And it closed above it. So when you go to this zone, you might think, okay, well, we've broken above the zone, and now we're good to go. But if we move price forward a little bit, we'll see that that just doesn't happen. In fact, we get a really big sell out of that area. This right here was a technique by the banks and by the big money to induce people to buy this asset. So they wanted people to buy because they were planning on selling. And here's what that looks like. People bought here, and their stop losses were probably right here, below this little support right here, kind of below this trend line, just in case, price did something like this, they thought it might shoot back up. Well, what happened was they bought here, and the banks knew that their stop losses would be somewhere in this area. So the banks drove price up like this so that these stop loss orders would be here. So if you're in a buy position, let's say this was your buy position, your stop loss order is a sell. So your stop loss, when it hits your stop loss, you sell that position back to the market at less than what you got it for. So basic economics, when the banks need to sell, when the banks want to sell, they need people who are willing, to sell from them. So what we have here, they break it out, and then they collect your stop losses on the way down. And as you can see, right when it gets past this area, it starts to gain momentum. So let's look at it on a 1-hour time frame. So you can see on the 1-hour time frame, this was our fake out. Let me move that. This was our fake out, because on the 1 hour, price never closed above this zone. It closed right at the zone, but we never actually closed above the zone. And remember, when it comes to price action, the higher up in time frame you go, the more reliable the data is. And this is a perfect example of that. On the 15-minute, it looked like a breakout, by all intents and purposes. You broke out and you closed above it, but it's only the 15-minute time frame. That's not enough data a lot of times in order to predict a larger trend. Oops. So let's go back now to the 1 hour. And you can see this was a fake out. Plain as day. So this zone was well defined, and they decided to break it out above there in order to get people to buy so that they could drive price down and take out their stop losses. So that's the breakout. Or I'm sorry, that's the fake out. And here's the breakout. Now, you can tell this is a breakout because you've got two situations here. You've got price closed once out of the zone, and then it gave us a nice candle right here. It did reject a little bit, but overall, it gave us a nice candle there. Let's move it forward. Again, it peaked back into the zone right here, but it just immediately started falling. And again, you could consider this another fake out as well, because a lot of times people, oh, I didn't mean to do that. Okay, so a lot of times people will, they'll be in this buy and then they'll get stocked out and then they'll see price start to go up again and they start freaking out because they're like, I was just in this buy. I know it's going to buy. So their bias is still the same. Even though they've broken this down, they've come out of this zone, they've gotten faked out here. They're still thinking, oh, I can buy this and it'll be fine. So they push price back up only to have it go down. Okay, so that's your fake out and your breakout, and that is one thing you have to consider when you're doing breakout entries, from your patterns. So beware of your false breakouts, and how you do that is you wait for price to close above or below your pattern, preferably on the 1 hour time frame. If you go any lower, like you saw here, if you go any lower, you can get faked out even easier. And if you're down on like the 1 minute time frame or anything like that, people just get burned down there because price action looks so dramatic on a 1 minute time frame. But in reality, you could get a huge move that looks like this on the 1 hour, and that's 150 pips. But on a 1 minute time frame, that might be 10 pips. A move that looks like that might only be a few pips. So we'll try to find something similar. Okay, so this move looks about the same. 12 pips, 13 pips. So the 1 hour time frame, while it might look, like price action is really moving, it's in reality it's not. So again, that just goes back down to the basis of the higher the time frame, the more reliable your data is going to be. Okay? So just a quick recap. We'll go back to GU where we had our first examples. A quick recap. You have your risk-taking entry, which happens when you're getting a zero cross here. Oops. You're getting your cross here, etc. And you're testing this. And you have an identifiable pattern. Okay? There's your risk-taking entry. Right here and right here. And then your breakout entries happen after the pattern breaks down. So essentially right here, right in this area. All right. And that covers it for our risk taking and our breakout entries.